Hello guys, welcome to the second of 5 lessons on 2.8 Finance, which is what is the financial sector and what is its role in the economy. So this is easily the longest of the 5 lessons that we're going to be doing and probably contains the most notes. So once you've been through this, you should have broken the back of this topic and have a good understanding of the various different financial institutions that make up the financial sector. And so the learning outcome for this topic is to be able to explain the role of the financial sector for the economy, including financial institutions such as banks, building societies, and insurance companies. So within banks, we're going to be looking at commercial banks or high street banks, the central bank, which is the Bank of England in the UK, and investment banks. So we'll be touching on the distinction between high street banks and investment banks. We'll also be looking at the role of building societies briefly and the difference between banks and building societies. And finally, briefly looking at insurance companies. So there's actually 5 different financial institutions that are covered on the syllabus: high street banks, investment banks, the central bank, building societies, and insurance companies. So this little graphic is from the Bank of England, and I think just helps to visualize very, very simply what high street banks do. So these are your high street banks, your commercial banks. These are the sort of banks like HSBC that you would see on the high street. One of the tasks for you to do later is to be able to name the big 5 high street banks in the UK. So I won't give any more examples other than HSBC, which happens to be the bank that I bank with currently. Other high street banks are available. So what do banks like HSBC do? In simple terms, one of the things they do is simply to look after your money. So if you are a saver, if you have money that you want to save, and if you deposit money with a high street bank, that money is much safer than if it was just at home under your mattress, for example. It's also going to give you interest. You're going to earn income on those savings. And in a future lesson, we will look at the role of interest rates. But if you put your savings in a high street bank, that will earn you some interest. So it's better to save your money with a high street bank than it would be just having your money at home in your purse or wallet or under the mattress. The government also insures any money up to £85,000 that you have in a high street bank. So even if the bank goes bust, then you should be entitled to up to £85,000 of your money back. That is guaranteed. That is underwritten by the government. So your money is much safer in a high street bank. The other thing that high street banks do, if we look at the bottom left there, is they help you pay for things. So if you are sitting at home bored during the lockdown, you want to buy something on Amazon, then you can pay for that with your debit card, or you can perhaps pay for that on your phone. And you can do that because of the banking system. So the banking system will automatically take the money out of your bank account and put it into Amazon's account. So banks will help you pay for things. They help their customers pay for goods and services. Now, if we look at the bottom right there, another function that banks have is they provide loans. So that might be a personal loan for you. Maybe you want to buy a car, but you can't afford to buy a car, so you need to borrow some money to buy a car. That's a personal loan. So a bank will give you or will grant you a loan for something like a car. They will also provide you loans when you want to buy a house, and this type of loan is called a mortgage. So if you want to own your own home, most people would not be able to own their own home if they weren't able to borrow money from banks. Most homeowners have something called a mortgage. So you borrow money to pay for your house and pay that back over a period of typically 25 years. Without banks, it would be much, much harder to get mortgages, and many people would not be able to own their own homes. Banks also provide loans for businesses. So Apple is a great example of a business that started out with a loan from a commercial bank in the mid-1970s. Without getting that loan, Apple would not have graduated from a garage in California and wouldn't become the multi-billion-dollar corporation that it is today. So 3 main functions of banks there. They look after your money, they look after savers' money, they help you pay for goods and services, and they provide loans like personal loans, mortgages, and business loans. More generally, what banks do is they act as intermediaries. They are a go-between. So they're lying between savers on the left and borrowers on the right. So savers deposit money in banks, but that money doesn't just lie around the bank's vaults getting dusty. Banks take that money and they lend that money to households and businesses who want to borrow. As we said earlier, you wouldn't be able to own your own home unless you're able to get a mortgage. Most businesses don't get anywhere without borrowing at some point in their lives, Apple being a very good example. So what banks do is they improve the efficiency of the market economy. If money is just lying around in a saver's house, it's not doing anything. It's not being productive. What banks do is they channel those funds from people who have more money than they're actually spending to those individuals who want to spend more money than they have. And as we said, that improves the efficiency of the economy. Without it, profitable ventures and other important things like owning your own home just wouldn't happen. So other functions of commercial and high street banks, other than what we've talked about so far, is they provide overdraft facilities. We saw this in lesson 1. So an overdraft is where you spend more money than you have in your account. Now, that may not sound like a very good thing, but what it does is it gives you some flexibility. So if you have a bill due on the 20th of the month and you're not paid until the 25th of the month, then you might want to go overdrawn for 5 days, and it's not a problem because you know that you're going to get paid on the 25th of the month. So there's no need to take out something like a loan because you only need that extra money for 5 days. So overdraft facilities are really important for businesses, possibly small businesses, and for households as well. Interest is charged on the amount that you borrow on a daily business, and as we said, on a daily basis, sorry. And as we said last lesson, interest rates are often quite high. Another thing banks do is they offer safe deposit boxes for very expensive items like jewelry. And perhaps more commonly, they provide foreign currency. So if you go on holiday, so you go off to France on holiday, you will want to change your pounds for euros, and banks will change that money for you. And they'll also change it back from euros into pounds when you come back from holiday. And businesses will also use those facilities. So if you're importing goods and services, you will have to pay for those in a foreign currency, and a bank will provide those facilities as well. So hopefully that's given you a good idea about what commercial banks or high street banks do. The next thing we need to look at is investment banks, which are different to high street or commercial banks. If you pause this video now and click here to watch a short video explaining the difference between investment banks and commercial banks, and we will then come back. So hopefully now you've got some idea of the distinction between commercial or high street banks and investment banks. So we've already seen that commercial or high street banks are used by both businesses and individuals, and they provide current accounts, which are accounts that you can access 24/7, and savings accounts, which generally have higher interest rates. And sometimes you have to give the bank notice if you want to withdraw any money from those accounts. They also provide personal loans, mortgages, and things like insurance, which we'll come to very shortly. Investment banks are different in that they are used by businesses only. They're not used by households. So investment banks are used by businesses only. They're not used by households. What do investment banks do? One of the things they do is they advise companies on how to raise money. And this might be, for example, if your business is becoming a PLC, a public limited company, which we looked at earlier in the course, you will want to issue shares on a stock exchange. So how many shares should you issue? What price are you going to offer those shares at? Who are you going to market these shares to? Who is actually going to buy these shares? Are you going to approach certain institutions about buying those shares? Investment banks will give bespoke advice to companies about how to do these kind of things. Another thing that investment banks will do is they will advise companies if they want to grow in other ways, for example, mergers and takeovers. So if business A wants to buy business B, how much should business A pay for business B? How much should it pay? Should it even be taking over in the first place? Who decides if the businesses are merging about shareholders? So how many shares will shareholders in business A have in business B? How many shares will shareholders in business B have in business A? All that technical stuff is what investment bankers will advise businesses about. So some banks have both commercial banking arms and investment banking arms. So Barclays, for example, in the middle of the screen there, Barclays is both a commercial bank and an investment bank. Some banks, however, are just high street banks. So on the left there, we see that the TSB Bank is not an investment bank. That's a purely commercial bank. It just has a high street presence. Whereas on the right there, a business like JP Morgan Chase, that is an investment bank only. So sometimes banks are investment banks only, sometimes they're high street banks only, and some banks perform both functions like Barclays. Finally there, another thing that investment banks do is they will trade on their own accounts. They will make money by wheeling and dealing and buying and selling various financial assets. So this could be foreign currencies, commodities like coffee or oil, bonds, which are IOUs, shares, and other complicated financial instruments which are called derivatives. But you won't be asked in the GCSE exam what a derivative is, so don't worry too much about that. And so now we come to building societies. And there used to be quite a big difference in the UK between banks and building societies. That difference is much less than it used to be. So I wouldn't worry too much about the difference between banks and building societies. There are some similarities. Like banks, they will offer savings products and they will offer mortgages. The main difference in the UK between banks and building societies is in the structure of ownership rather than the types of products that they offer. So building societies tend not to be PLCs. They're not public limited companies. So you can't buy shares on the stock exchange in building societies. They are what we call mutual organizations. So they are owned by their members. That's their customers. So if you have an account with a building society, you have rights to both go to and speak at annual general meetings, and you can vote on any issues that the building society is discussing at their annual general meeting or deciding upon. And it's one member, one vote. So unlike in a PLC, where the more shares you have, the bigger a say you have, that's not the case in building societies. That's the main distinction that you need to know, that building societies are not public limited companies. You can't buy shares on the stock exchange in building societies. Otherwise, I wouldn't worry too much about the distinction. It is possible to say, some people have certainly said that building societies maybe provide a slightly more personal service than banks do. And it's also the case that building societies tend to be smaller than banks, perhaps organized on a more local level. So you tend to get a lot of building societies that just have a local presence. So now we come to insurance companies. Now, some banks offer insurance, but the largest insurer in the UK is actually not a bank. It's a business called Admiral. You might have heard of the Admiral brand. You might have heard of the Elephant brand as well. And best thing here is to take an example. So suppose you buy a car and you want to insure against the possibility that that car will be damaged or the car might be broken into or something like that. What you will do is you will pay a company like Admiral a monthly fee, maybe £40, maybe £50 a month. And if something goes wrong, if that car gets damaged or gets broken into, then the insurance company will pay you some money. They will pay you compensation to have that car repaired, for example. Now, there's two very important things to say here. One is that risk is a really crucial factor, not just with insurance companies, but with banks as well, which we'll look at in a future lesson. But what insurance companies have to do is they have to assess the risk, because they don't really want to pay out unless they absolutely have to. The higher the risk, the higher the payment every month you will have to make. So if you live maybe in a slightly dodgy area, then you will probably have to pay higher car insurance than somebody that lives in a relatively safe area. If you have a record of being a very safe driver, you will tend to pay less car insurance than somebody who has had a lot of accidents. The risk might vary according to age. It might vary possibly according to gender. So the insurance company has to assess the risk. The other thing to say is that insurance companies, like banks, which we've not said already, are profit-making institutions. The real purpose of an insurance company is not actually to pay out compensation to you, it's to make money for its shareholders. So Admiral is a public limited company. Many insurance companies are public limited companies, and their objective is to make profit for their shareholders. So although they will pay compensation if something goes wrong, they don't want to pay that compensation unless they absolutely have to. Having said that, from your point of view, it is a very good idea to have insurance. So you must have car insurance if you drive a car. And it's a good idea to have other types of insurance as well. For example, if you have a pet, you might not want to pay every single time you take your pet to the vet. So you might take out pet insurance. It tends to be just a few pounds a month, for example. So things like car insurance, things like pet insurance, and the other examples there, buildings, home contents, and health, they're types of what's called general insurance. They all fall under one category there on the right-hand side. And the other category there on the left-hand side is life insurance. So life insurance is when if somebody dies, money can be paid out in compensation to the surviving family. For example, your husband or wife, if the person who is insured dies. This also covers things like pensions. So if you have a pension and, for example, you die before you are able to take that pension before you get to retirement age, then your husband or wife may be entitled to some compensation. So that's life insurance. And the final type of institution then is the central bank, which in the UK is the Bank of England. So the Bank of England, again, you've got to think of this as different to high street banks. The Bank of England is part of the public sector. Most banks are part of the private sector in the UK. Some banks were nationalised or part nationalised, which meant they were owned by the state following the credit crunch. But the Bank of England is a different kind of bank. So you and I, as households, cannot get an account with the Bank of England. The Bank of England is the bank for the government. It's not a bank for households. So the Bank of England is the bank for the government. The Bank of England is also the bank of the banks, which means that if a high street bank is short of money, perhaps very, very short term, then it can borrow from the Bank of England as a last resort. The Bank of England doesn't want that to happen unless it absolutely has to pay that money out. So if a high street bank is short of money, it will tend to borrow from other banks in the first instance. It will only borrow from the Bank of England if it absolutely has to. The Bank of England will only lend as a last resort. The Bank of England is the bank of the banks. So banks, high street banks, will hold accounts with the Bank of England, and those accounts will pay interest in the same way that if you and I have an account with a high street bank, those accounts pay interest. And high street banks can borrow from the Bank of England, and they will be charged interest on that in the same way that you or I would. Bank of England has got other roles that are very different to high street banks. They issue bank notes. So in England, at least, the only institution that can issue bank notes is the Bank of England. Although we call the Bank of England the Bank of England, it is actually the central bank for the whole of the UK economy. So that includes England, Scotland, Wales, and Northern Ireland. It also sets the official interest rate, which we call bank rate. And high street banks will tend to follow the lead from the Bank of England. In other words, if the Bank of England reduces interest rates, which it did a few months ago, following the outbreak of coronavirus, then the high street banks will tend to follow suit. So the Bank of England cuts interest rates, then you will tend to get a letter home saying that the interest on your savings account has gone down. Similarly, if you have a variable rate loan, which means the rate can change when the Bank of England's rate changes, and if the Bank of England raises its interest rates, then you will find that you will be tend to paying more on your mortgage and more on your personal loans if the loan is a variable rate loan. Some loans are fixed rates, but if it's a variable rate loan, the loan will tend to vary according to what the Bank of England does. You will learn a little bit more about bank rates and the role of the Bank of England next year in year 11. But for now, it's just useful to know that the Bank of England's rates influences high street rates. The other two things the Bank of England do, you really only need to know in passing. It manages the gold and foreign currency reserves of the UK, which again will become more important next year when you look at things like exchange rates. But it also regulates the financial system. It's a watchdog. It keeps an eye on banks and building societies and tries to make sure that they are not behaving recklessly. Maybe they're not lending irresponsibly, and making sure that they don't misrepresent the products that they are offering to their customers. So the Bank of England is a watchdog. It is keeping an eye on the financial system as a whole, as well as individual banks and building societies. So this is the summary of the key points that you need to take from this lesson. Have a read through those and have a go at the questions at the end of this lesson as well. Hopefully you have enjoyed that, and I will see you for lesson 3.